Well, if you like lively market conditions, we are seeing that now, and it is getting pretty lively across various asset classes at the moment. Now, we have seen in the equity market rotation taking place from growth into value, but what we've seen now is that tech has absolutely fired back. Nvidia's just put on 12%, a record amount of market cap coming through in one day. Now, large of that is down to what we've been seeing from AMD and the outlook that they've been suggesting, but Meta have come to the party with a huge CapEx guidance as well, and we've seen Qualcomm come out with good numbers. Now, we've just seen the Fed meeting. Now, for people who didn't think that we were going to get a rate cut in September, I think they've pretty much given us that they're very much in that camp. In fact, a few Fed members are suggesting that we could have seen rate cuts at this meeting as well. What does that mean for markets? Now, we have a look at the Australian CPI print and the idea that what was near a debate about rate hikes is firmly now, when will they start to cut? We've seen the Bank of Japan meeting. A lot's going on there with a massive rally coming through in the Japanese yen. Gold's looking pretty perky. There's a lot going on as we look forward to more earnings and payrolls in Friday. So a lot going on. This is the trade-off. Well, hello, Chris Weston from Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. We will be discussing a lot. To be fair, there's a lot going on in these financial markets right now. Whether you're looking in equity markets with earnings coming in thick and fast, and they are being dissected and causing big ripples across markets. You know, you thought the tech trade was out, it's back in vogue again. We've seen central banks coming to the party, gold looking like it might want to test new all-time highs. There's a lot going on. So Mr. Blake Morrow, the Volatility Whisperer, come into the programme. I was watching one of your programmes this week. We're going to get into the Bank of Japan. We're going to talk about the yen because the yen's been one of the big moves in FX markets. But you came out of your week ahead this week. You talked about a fairly explicit playbook guide, way to play the dollar yen and the yen pairs this week. I think you've just absolutely nailed that one. I'm not sure if you want to sort of talk about, your own book and everything like that. But, we make some money. We lose a lot. But I think you've nailed the yen for your subscribers this week, right?
I think I did, and thank you, Chris, for noting that. I shorted dollar yen above 155, covered it around 153, then picked it up on the long side at 152, spun out of it at 154, and all of this was just before the BOJ because we got the sources. The sources from the
Nikkei
BOJ
newspaper.
Yeah, as soon as they just kind of fast-tracked my trade plan a little quicker than I thought. I thought I was going to be doing the whole plan through the BOJ, but all in all, it's been a wild last few days in the FX markets. And hey, volatility, it's here. And Chris, I think it's here to stay. Next month, so many people take the month of August off, but I don't. Would you bet on lower volatility next month, Chris?
Hell no. No, I mean, we're just getting going in the elections. We're not going to see people really trading that till in the FX market till September, maybe a little bit later. But it's all shaping up well. You've got rate cuts coming through. The Fed. Screw it. Let's take the market pulse and talk about it in there. Let's get it going. I just wanted to bring it into a formal setting. So would I bet against volatility? Let's do it here because otherwise the producer's going to get upset because he likes the countdown clock. No, I wouldn't. I think right now we've got a bit of a sweet spot, right? We've got the Fed who have basically said, everything will plan, we're going to get a rate cut in September. One could argue that debate, which is 100% priced for a rate cut in September, and we've got 2-3 rate cuts being priced in by the end of the year, 8 by over the next 2 years. Could we see a weak payrolls number on Friday and we actually start raising a premium for 50 basis point cut? Now, I've always said that 50 basis point cut's probably more of an emergency cut. But right now, I think, we've got this kind of perfect storm really for risk in that the earnings in the US have been very, very strong. Margin growth has been good. The AI trade is back on. AMD have told us that they're selling a lot of GPUs, and that's resonating into how Nvidia's trading. Meta have come out with an amazing capex number as well, and of course, as capex is one of the big factors. We saw that disappointing capex number from Alphabet. Meta have changed that. And that's really important for the sort of business growth going forward. But rate cuts coming through, you've got a cooling labour market, but it's not collapsing. Inflation is glacially coming down to trend or to target. It's frustrating, but it's in the US, it seems like it's going there. We've got this perfect storm for equity and risk assets. I think there is a big difference for me between rate cuts and insurance rate cuts, and that where the Fed need to front load and get it ahead of the curve, which is not the market's base case at the moment. So we're expecting cuts. I think something would have to radically change for that not to be the case, and we look forward to the next minutes. But it feels like we're in a pretty sweet spot here for risk. How do you see that?
Well, I have to say the Fed just kind of put the cherry on top today. They painted a picture of basically a soft landing. They still need a little bit more confirmation before they start cutting rates. Could we get front loaded? I actually thought that today there was a bigger chance that we would have gotten a rate cut just to avoid the political backlash the Fed might face in September, which begs another question: are they really going to cut in September? But anyway, I do think that we have this sweet spot because the market, there are a lot of people that are waiting just to sell stocks when the Fed actually does cut rates. So when they do cut rates, and I don't know if I necessarily subscribe to that idea or not. I'd have to see kind of the proof would have to be in the pudding with price action. But at the same time, we didn't get a cut. We're still expecting a cut. Nothing's really changed. Maybe there is a softish landing. Stock market likes it. I think earnings aren't horrible, but we have three big swinging. Don't want to say that. Big swinging companies that are reporting. Three of the Mag 7 are going to be reporting over the next couple of days. That I guess we should probably wait before Apple, we get Amazon, too terribly bored, right?
And Intel. But yeah, look, I think you raise a good point. Look, one of the big takeaways I've seen from the Fed is that there were actually members who were debating whether to cut rates at this meeting. So we wait for the minutes that come out on the 21st of August to understand just that dynamic of how many we're calling for. But what we've seen is a further confirmation that the Fed now have this move away from inflation, where the employment market, the labour market, is of equal focus as inflation. That tells me that their concerns have lifted a little bit. That puts us on notice. Now, if we get a weak payrolls number on Friday, I think as long as the payrolls number is in that sort of 150 to 200,000, that's a good situation. But it's that unemployment rate. If we were to get above 4.1%, I think that could see a bit of de-risking coming through in markets. The SARM rule, we heard that from Bill Dudley in his Bloomberg article. So we're in a bit of a sweet spot at the moment, but things could change. I think the labour market is really key to that. If we were to see some big fragility playing through or some increased signs of fragility, we could easily start seeing 50 basis points being opened into market pricing, especially with the news flow we're now seeing in the geopolitical situation in the Middle East. I don't think markets would necessarily like that. So insurance cuts are good for market. If they start getting ahead and we start needing to sort of front load it a little bit more, I think markets de-risk on that.
And I'm surprised we've had very little reaction to that. Anyway, I know we spent a lot of time just talking about the markets and the Fed, but let's talk about maybe divergent central banks here. You got the BOJ. One of my colleagues, K-Man, he was talking today because he listened to the Ueda presser. I couldn't stay up after 16 hours in front of the computer. He's a sucker for punishment.
Why would he do that?
I couldn't. But he's in the UK, so he was up. He started early. But he said it was the most, and he used to be a bank trader on a bank desk trading yen in Japan. So he's like, this is the most hawkish central bank meeting that a press conference I've seen from the BOJ in years. So you got the BOJ, which is going to be raising rates, potentially setting the pace for now maybe a quarter point as they brought it up 15 basis points, be at 25. You got the Fed that's possibly going to front load cutting rates. What is this a game changer with the BOJ? What are your thoughts?
Well, I think the Bank of Japan have had a history of they never miss a chance to disappoint the market. So this is the first time for a long time they've actually hit the market sentiment and the market pricing. And I actually thought that the fact that they raised by 15 basis points was a very positive sign that they have firm belief that they're in control and that the economics are evolving the way they want. I think it's possibly why we saw a bit of a pop in the Nikkei on the back of that initially. But yeah, I don't think the data's there for them to cause an out cycle. I think what we've seen in the yen is, you've seen a lot of weak hands closing those yen short positions. That's encouraged then a lot of the fast money leverage community to start selling dollar yen as the yen strengthens. So I think a lot of the leverage community are now long yen. I still think there's a lot of legacy shorts out there from people who've been holding a long held carry position, and they may be looking at that situation. So the fast money guys are now firmly looking to sell rallies in dollar yen, Aussie yen, Kiwi yen, these pairs. But it's a positioning exercise. I don't think the rates dynamic is a game changer. I personally don't think it is. It's a game changer myself. But there is, clearly, I think if you look at the technicals, the flows, people are looking to sell rallies in dollar yen. But I want to go back. I want to sort of skip out the earnings side of things because we covered that. I do think the earnings are coming in hotter than expected, and they're good. And we look forward to Nvidia now. I mean, obviously we've got Apple coming out after market in the session ahead, and there's expected about 4% move on those, and they could be quite interesting. But it's Nvidia is the big one, and they don't come out till 23rd of August. And Jesus, if they can break the 50-day, off it goes, and it's staggering to have a company like that rallying 12%. Let's go into metals though, because geopolitics. Now, I'm not a geopolitical expert. You're not. I know you're probably more than I am, but I just follow price and let the market tell me what they're thinking. But the news flow is certainly more sinister now. Whether this blows up into something a little bit more dark and causes supply disruptions in the oil market is yet to be seen. But we are seeing gold looking a bit perky now, Blake, and we'd look at the technicals. Do you think we break to new all-time highs? I think we got to about, 24.83 was the intraday high, a little bit lower on a closing basis. Aussie gold looks good at the moment. But do you think we break to 2,500 in this run?
I do. And, I wasn't a believer a week or two ago, but something big really happened, Chris. We've seen fixed income, whether you're talking about the 10-year, they're ripping, yields are coming down. Look at Boons. Boons are rallying and breaking out, and as yields come down, precious metals catch a bid. Pullbacks have been minor, and I still think retail sentiment is too heavy right now, but retail can be right. They're not always wrong. Gold's pullbacks have been minor. Silver might be a different story, but gold looks like it's going to take on new all-time highs.
Well, I think so.
That's how I'm feeling about precious metals right now. I think
when you're looking at a hedge against geopolitical deterioration in terms of the news flow, and obviously we're watching, what's happening between Israel and Iran, and I'm not going to opine on that, but gold does its best days as a hedge against geopolitical issues there. But when you actually get the extra kicker that the Fed are cutting, or they will be cutting, and we've got, as I say, 2-year yields have gone from around 5% in May down to what we're currently seeing around 4.25. So it's a decent bid coming through. You've got these double headwinds coming through. So can it kick? We'd obviously wait. If momentum can shift, we get a bit of a higher rate of change. Then you start getting the CTAs, the momentum systematic funds, and that's pushing up the futures. The ETF funds get the inflow, and it could rip. It's not there yet, but when you've got those double headwinds, double tailwinds between geopolitical considerations and the Fed cutting, it could feasibly happen. We'll see. Anyway, let's go to the technicals and have a look at that's a setup. Let's go dollar yen. I know this is your world right now. This is your puppy. This is where you're going to be taking Mrs. Morrow out for a nice steak over the weekend. Thank you, Mr. Ueda and the Bank of Japan and all those people who've been closing out those yen shorts. But I like the setup here, Blake. And I mean, look, we could have gone Kiwi yen, Aussie yen. It's a currency pair that I looked at last week, which are really just dropping at quite a ferocious pace. Obviously, yesterday with the what we saw from Aussie CPI, which has taken a rate hike off the table in the market pricing, and people are now debating whether we're going to get a first cut. Aussie yen has just been whacked. But dollar yen's where we've seen the bulk of the flow, as you'd expect. And we broke the long-term uptrend. We're breaking all kind of prior highs resistance. I mean, we've gone through the daily cloud. If you're into Ichimoku cloud, this is something that Japanese traders look at very closely. And it is in free fall right now. I haven't got a 5-day exponential on there, but you can see that it's defining all rallies. And I think this below 150, I think you're going to see more legacy shorts who have held on that long-term carry position looking to close. This is one that just is front and centre on FX traders' radars, and I think this goes lower. I'm a seller of rallies here, Blake.
Well, Chris, you nailed the New Zealand yen last week. You said sell the rips, and boy, did it just
I don't know if we got the rip there, did we? Yeah. I didn't trade it myself.
You did. You got a little bit. I mean, define rip. You got a bounce. You got a little bounce to sell into, but great call. It went straight down, and it's been in the toilet ever since. So great. But, speaking of the Kiwi, I want to take you over to the Aussie Kiwi. The Kiwi itself has been demolished over the last, several months, especially against the Aussie, because the market had been pricing in a potential rate cut. Now, you may argue with me, and I'd love to hear your input right at the very end here, that yesterday's CPI data out of Australia really dampened the idea that we are going to get a rate hike. So you got the Aussie Kiwi selling off and reversing back below 110.50. So now I'm looking to sell rallies up into that level. I think the 110.50 level is going to be a great place to be on the short side, targeting that lower channel support. And by the time we get there, should we get there over the course of the next couple of weeks, it's probably going to be closer to the 200 DMA. But Chris, what are your thoughts on that CPI data yesterday? I'm going to leave you a little bit of time.
Thanks, mate. I'm actually going to take the other side of this trade. I'd actually be looking at lower levels, probably down into the 200-day to buy. Maybe a little bit, sort of around the 50, in between that. I think lower levels are a buying opportunity for me. The trim mean number is the one you want to look at. So the trim mean number is effectively core inflation, core CPI, but they take out 15% of the most volatile components within the basket and the bottom 15%, and you're left with a much less volatile CPI basket, which is what they kind of set policy to over the headline number. And that came out at 3.9%, which was below expectations. The RBA themselves had a forecast in their statement of monetary policy at 3.8%. So it was there and thereabouts. It wasn't enough to give them the reason to hike rates. And so the rate setting now has come completely off. Any talk of hikes next week have come out of market pricing. But also, Aussie Kiwi has been the default macro funds go-to position for relative rates play. And there's so much capital and such a large position in Aussie Kiwi. People have been doing it through cash, but also, in knockouts, digital knockouts, optionality. And it was such a rich position because everyone was just like, this is just too easy. You've got one bank raising, you've got another one looking to cut. It was very rich. A lot of that position has come out. But I still think you've got an RBA who will be higher for longer and an RBNZ who will be looking to cut sooner. That's why I'm a buyer of pullbacks. But yeah, we'll see. So we're taking two to two. No, neither of us have got a fill yet, but we're sort of different sides of the spectrum there, so to speak. Anyway, I want to bring it to crude oil. And I partly wanted to bring this up because I know that you don't like trading crude, but I do think this is one that we want to keep an eye on. Now, obviously, we've got that longer-term triangle pattern in play. There's been big consolidation. We saw that massive range. That's now consolidating. The buyers have, over a longer-term period, of sort of struggling to make their emphasis known. The sellers kick in, but also on the downside, there does seem to be a nice level of support that comes in, and you get that rip down, and people are looking to reverse into that as well. So we are consolidating. And it's not going to happen overnight, but there will be potentially that, given the length and the maturity of this consolidation, that when it does break out either way, it could be a very powerful situation. Now, of course, we've got our eyes on this on the news flow coming out of the Middle East. If the market was to suspect that we do get supply disruptions in gas or in crude, you could see a significant rip going forward, and that break to the top side. Gold's going to go. Swiss franc will do very nicely, and maybe that gives an extra kicker to the Japanese yen as a safe haven there as well. And we've got the OPEC meeting coming up in the session ahead. Whether we get anything that moves the market is yet to be seen, obviously. But I think this is a long-term consolidation. Does it break out? I think it's one that we need to be watching very closely now, because we are seeing volatility pick up, range expansion, good for the day traders, and we've got that geopolitical headlines, which I think really do need to be monitored here.
Yeah, and if there's one thing that'll kill a soft landing is just higher energy costs.
Correct.
So
yeah.
if it broke out to the upside,
Trump. I know he hasn't won an election, but he is promising, and that if he came in and we were to see a red wave, or I might be able to get it through executive branch, but they're promising to increase production in the US by another 3 million barrels, which is very, very punchy. And of course, if that was to happen, and it wouldn't happen overnight, but just the market would front run that, 3 million barrels a day of extra crude capacity in the US would smack the US crude price if it was to come in. So when we're looking at Trump trades going forward, I do think the energy equity sector is going to do very well because of talk of deregulation. But at the same time, he's also promising increased production, which would smack the market there as well. So something to keep an eye on.
Drill, baby, drill. And I have to say, Chris, I know the producer's going to kill me right now, but you did a great video on the U.S. elections. You are more of a political U.S. political analyst than I'll ever hope to be.
Well,
so if you guys haven't seen that,
let's do a separate video on that together. We will.
We can do it. But
I'll talk to you about your political landscape.
Oh boy! Oh, well, get me some hate mail. But I will say that it was a great video. If the viewers here have not watched that video, you should do it tomorrow. Or today. It's great. Okay. Last but not least, Euromex. Look, this is the carry traders wet dream of a trade. And it's also, if you want to really smack a carry trader, just buy the Euromex. But you'll notice, Chris, I used the term last week on the US dollar Norwegian krona, the massive, massive, massive weekly trend line. This is another massive, massive weekly trend line. And frankly, I don't have any skin in the game here. I don't have any peso exposure, but I just want to point out what a critical level this is. And if you really want to know, because you guys at home are going to have an opinion. Stocks they're not going to make new highs. They're going to reverse. Stocks are going to go to new highs, and we're going to keep going, and we're going to reach for new highs as we get through the U.S. elections. Whatever your spin is on the market, you can express it right here. The Euromex on a breakout above 2045, I think is what the resistance is, maybe 2050. You break out above 2050. You're going to go higher, and that is going to be risk off. That means that stocks are really coming down. The flip side is it looks rather compelling to short it, which means that would be conducive to equity markets continuing to rally from here. So really nice pivot you can trade from. I think traders, this is a setup, so you can trade either direction based on whatever your bias might be.
That's right. Okay, cool. Let's go to play of the day. Well, I'm going to have a look at XAU AUD, which is basically effectively gold priced in Aussie dollar terms. So, if you want to be so bold and if you want to be a bit more daring, 95% of our clients trade XAU USD, so just gold in US dollar terms. It's the sort of generic one as well. But what you can do if you want to get double bubble is you can, if you think that the Aussie is going to go down, is you would buy an asset in the perceived weakest currency. If you want to go short, you want to buy it in the strongest currency, and then you can get the double effect of the currency situation there. So we've got gold priced in a number of different currencies: Swiss, Euro, Yen, Sterling, Singapore dollars. There's a whole few of them. So if you taking a view that you think the gold price is going up, but you also take a view that the Aussie is going to be weaker going forward, you can get that double kick, and it can really help out. A lot of people think that's very complicated because getting currencies right in the first place is there. But look, we've got those geopolitical headlines in play. Are they going to go away anytime soon? Obviously, we'd hope that. I would hope that would be the case, but it feels like there's more to come in this, and it feels like there's more hedging to come through. It feels like the rate of change still needs to kick to the upside. If we were to see that and higher volatility playing through, I think the Aussie's going to come under a bit of pressure. We have seen a bit of a psychological shift in the Aussie dollar, and just look at it technically, we've nice rounded bottom, we're coming up. It feels like this could kick. I think pullbacks will be a buying opportunity. I feel like this could start trending. And I like this trade there, so I feel like this time next week will be higher, and I want to jump on board this any kind of potential rips here.
I knew it, Chris. I knew you were a closet Aussie bear. I knew it, and now
I'm not really. I'm not really, but I'm just look. This is more about just forget about the dynamics. What I've just talked about. Forget about everything out there right now, Blake. If you look at that chart, would you be long or would you be short?
I would not want to be short. Let's put it that way. How about that?
Well, well, we don't know where it's going to go, but it feels like to me that the probabilities are that it is skewed towards the upside.
And that is a de-risking trade like you've never seen one. Exactly. I love it, Chris. I just like to harass you about because you live in Australia. And you're fair. Anyway, hey, so a couple weeks ago, let me talk about the euro dollar. But a couple weeks ago, we used the term yours. And Chris, what does yours mean?
To me, sell.
You're a seller, right? And mine means bring it. So I want it. So the euro dollar, I am bullish the euro. I'm actually going to play off of Chris's tagline from a little bit earlier in the show where he said, I think that U.S. economic data might start to show some softness, especially in the non-farm payroll. The way I'm playing it, look at how the 200 and the 50 DMA are wound up. We found a lot of support here. And I think while we're above 108, the next stop is going to be above 108.50. And I'll be looking for a challenge of that trend line resistance of the big triangle. Now, here's the thing, Chris. If this pennant or this flag plays out, it points above that triangle breakout. Now, I really would love to see a consolidation breakout like this triangle finally breaking out above 110. And could we get the juice from down here? Potentially, but we need a weak jobs number. But I'm already playing long the euro dollar, and I'm looking to add to it on weak NFP data come Friday. So that's my play of the day, Chris.
With the with payrolls, Hurricane, what was it? Hurricane Beryl? Was it Hurricane Beryl? They're talking about jobs numbers being affected by the hurricane, and also hot weather in parts of the country. So it wouldn't surprise if we were to see a soft payrolls number, and then everyone will justify it by these one-offs that took place. Sure. I think with payrolls, though, the more important thing for me, for markets, should we say, is that unemployment rate, which is priced off the household survey as opposed to the establishment survey, and that's really volatile. So, but if we were to see that, Bill Dudley, the ex-New York Fed president, came out last week in a Bloomberg op-ed piece and talked about the Fed needing to sort of get ahead of the curve because of the SARM rule and front-road rate cuts, and he's getting more concerned, and he's well respected in markets. So, if we were to see a higher unemployment rate, it could cause some volatility in the dollar. I think gold price is probably trading to new all-time highs on the back of that. So one to watch, but it could be down to the old hurricanes and the one-offs that we always see from economists. Anyway, thank you very much, Mr. Blake Moreau. Thank you, everyone at home, for watching. And obviously, if you can, smack the like button. We'd really appreciate that. Thank you for sticking around. See you next week. And stay safe in these lively markets.